Hello and welcome to another episode of the Financial Advisor Forums 2014-15 presented by UTI Mutual Fund and CNBC TV18. I'm Sumit Lakhotia. Now throughout the series we travel across the country with our leading financial advisors and we talk to them about the key issues, the challenges and the way ahead for the mutual fund industry in India. Earlier we were in Jaipur and also Hyderabad, and today we come to you from Bhubaneswar, which is hailed by the World Bank as the best place to do business in India. And joining me now on this panel are Suraj Keli, Group President, Sales and Marketing, UTI Asset Management Company, Naresh Pachisia, Managing Director, SKP Securities Limited, and Brijesh Dalmia, Founder, Dalmia Advisory Services Private Limited. Gentlemen, thank you so much for being on the panel. Now, we've found out some figures from AMFI about the percentage of the assets under management that come from cities around the country. So, Bhubaneswar contributes 0.37%. Now, you look at other figures around. So, Calcutta is 4.83%. Guwahati is 0.31%. But I'd like you to shed some light on the fact that Bhubaneswar is one of the top emerging cities in India, especially in the IT and education hub. Are you seeing that Bhubaneswar has a lot of untapped growth for assets under management?
Yeah, if you look at it, from a Bhubaneswar perspective, in fact, I would even generalize from many second-tier towns, that we visit. What I find is a direct correlation between fixed income assets and the size of the assets of the industry. So in markets where fixed income sales have been substantial, so if you look at Mumbai, because of a large corporate presence, Delhi, Calcutta, Chennai, and I contrast it with, let's say, Bhubaneswar. What I find is the fixed income assets as a proportion of assets, overall assets, are pretty low. So clearly it shows that the advisors in this particular city are leveraging the equity side of mutual funds, but they are not really, trying to sell enough of fixed income to their customers. And I do believe that from an asset allocation perspective, it's important that you sell all the asset classes.
When you see interest rates going down, fixed deposits are likely to give you that much lower returns going forward. However, if you are in debt funds, because they capture the interest rates decline through appreciation in bond prices and thereby their appreciation in NAV, so that uptick is missed out by fixed deposit mobilizers. It's easier to sell fixed deposits. So, but then is it beating the inflation? For example, they are sold for capital preservation purposes. Now, if you are not able to beat inflation, but more so tax adjusted, then in that case you are actually reducing the power of your money, purchasing power of your money.
A fixed deposit is a little less attractive for someone who's in the top bracket of tax paying, so they have to pay over 30%. So do you think maybe is that another reason why people here might not be so fond of debt mutual funds and would just say let's just put it in fixed deposits?
I find it that advisors necessarily are not approaching their clients to invest in debt funds. A debt fund has many advantages over fixed deposit, over and above the returns that a fixed deposit provides or a debt fund provides. Because, for example, if you really see the last 12 months, fixed deposit might have given you 9% or 10%, but simply because of a debt fund upside, because of the interest rates going up, investors are getting 15%, 18%, 20% also. So, while it offers convenience as well as flexibility, the returns also can be increased in a debt fund. The another advantage which advisors need to tell their client is that when you invest in a fixed deposit, there is a fixed maturity term. Well, whereas in a debt fund, there is no fixed maturity term. You have to start understanding the debt fund and approach the client to sell these funds, and because of the flexibility and convenience. Returns also are similar.
Is it important to maybe every year, every 2 years, do some kind of a refresher thing voluntarily to upgrade your knowledge so that you are able to sell the correct product to your customer?
Absolutely. Problem is that most advisors land up actually distributing products, just selling products actually. and so they are not able to capture the imagination of and loyalty of the customer because of the product innovation coming up, new products coming up, and new ways of thinking about this connection between the needs of the customers and their financial goals and the products available. It's important that refresher courses needs to be done. Like doctors have to also go through those refresher courses.
Of course, exactly. I guess that's what we're trying to achieve with this forum itself, to kind of create some more awareness, to bring out, to share more knowledge with the community here.
If I can just add to this, I'm itching to, make a point here that actually when you look at the fixed income category, there are two sets of products here. There's a set of products which are as simple as a fixed deposit, which are called the fixed maturity plans.
Yeah.
And then comes a set of products where you need a little understanding of, how interest rates move. So the so-called duration products, or a accrual product, if you're taking a little more credit risk in your portfolio. So my sense is that even before you look at, refreshing your learnings, you can start with very simple products, and ensure, and customers would love it because till they get a return better than a bank.
Of course.
They would be very excited about investing in these products.
It's important for an IFA to move from just being interested in a transactionary role and move to an advisory role, because that will lead on to a long-term commitment from the client. What is your advice?
So you have to start with an intent that, I will take care of the requirements of the customer, and till you start with that intent, I think you're already off to a good start. The second part is where you start saying that, can I ask some basic questions, which ensure that the product or solution that I'm offering or any advisor is offering will meet the basic requirements of the customer. Investing as a business is a lot of experiential things are involved in it, so it's not like, you give a product and that's the end of it. Tomorrow the market moves, you need to handhold the customers when markets don't move in the direction that you and I believe that market should have moved in the first place. So I do believe that there are several aspects of this role, but once you start on that journey, I think you'll get from a transactional person to an advisory.
You're watching the Financial Advisor Forums 2014-15, presented by UTI Mutual Fund and CNBC TV 18. It's time for a very short break. Don't go anywhere. We'll be right back. Welcome back. You're watching the Financial Advisor Forums 2014-15, presented by UTI Mutual Fund and CNBC TV 18. How should an IFA control these emotions of the customer for the customer's long-term benefit?
Well, you see, somebody sometime asked McDonald's what business you are in, and they answered they are in the entertainment business. People don't come only to eat burgers. We manage expectations of the client and investors. In the same way, financial advisors are essentially managers of expectation of a client's emotion. So all a client expects is that when things are good and things are not so good, somebody should talk to me, somebody should handhold me and explain me the situation and take me through. So in the initial years, a lot of hand-holding and comfort is required on the part of the financial advisor to be given to the clients. So more than anything, more than any action, it's required. It's the commitment of the advisor to the clients that I am there, available, to talk to you, to meet you, to sort your questions out.
Mr. Pachisa, there is this Italian economist called Wilfredo Pareto, who came up with the 80-20 principle, which is basically that 80% of your sales are from 20% of your customers. So I'm sure it must be here also, where IFAs will feel that a majority of their income, a majority of their sales are coming from fewer customers. But how advisable is it for them to even look at the other end of the spectrum?
Very simply put, unless you reach out to 100, you don't get those 20 also. So you have to address those 80 to get those 20 also. And you never know tomorrow which one of those 80 is going to be on this side of the 20 actually. So it's very important.
Some people have this view that the mutual fund industry, there are so many products, and that gets confusing for a layman investor. And when he comes to the IFA, he's already a little bit wary, a little bit afraid, because there's so many products out in the market. How should this be sidestepped? How should this little bit worry in the heart of the client be addressed by the IFA and maybe by the AMC also? What's your thoughts on that?
Well, I think first of all, you should look at it positively, that you have choices.
Okay.
When you go to buy clothes, if you have plenty of variety, do you complain about it? So I don't know, why would you complain if you had so much choices in mutual fund products to begin with.
Point taken, right?
The second point I would make is that when you're making a choice, what is broadly important is that you build it on various categories of products that you're buying. So till you do that little homework like you would do in buying any other product category, I think you will be finding this space also very easy to navigate.
On a lighter note, choice is the biggest stress creator also. Okay, so here our financial advisor's role is to reduce this stress of yours by actually within the universe of products available to shortlist what is good for you. And this, I think, should be taken by the advisors as a big career opportunity, that more the choices, more the customers will need the advisor's advice, and that's going to be a very good career growth opportunity there.
It's obviously very important to set financial goals, but how can we make it easier for the financial advisor to actually explain this to the customer that please first set a financial goal. You have money, but what do you want that money to become and in how much time?
Now, if the customers sometimes are not very clear about their financial goals, okay, generally, it's very interesting that generally most of the HNIs are not aware about their financial goals because they think they have met all their financial goals. Then in that case, the simple thing is to ask and find out about the risk-return profile, how much risk you can take or how much return, And generally, very interestingly, when you ask people, what do you want to do with this money? They said, ज़्यादा से ज़्यादा return, कम से कम risk, जल्दी से जल्दी मिलना चाहिए. So, this is very, very subjective. You don't get it. So what you do is make the customer understand that, okay, for this kind of a return expectation, you have to take this kind of risk, then it's fine. So the client you are giving an opportunity to the client to take a calculated risk. And similarly, if the customer is being very, very risk averse, then he should get prepared for lower returns as well.
Okay.
To add to this, most of the time I have seen when I meet advisors across the country, most advisors go to a client's place with a pre-head notion to sell a particular product or scheme. They don't engage in a conversation with the client what they want. So the pre-set notion in the mind do not allow them to ask relevant questions to the client. So they are there to sell a particular product. As Mr. Pachesia is saying, they should engage the client with a conversation what they want, what is their risk profile, what is the return they're expecting, and what is the real scenario in the marketplace. And understand that requirement and then pitch a product. This is a game changer if they can do that with their clients.
How can the IFAs also do their bit of educating their clients so that, this same thing that we're all talking about, that the client is also more trusting and is more educated, so the client also makes the correct decisions.
India, where it is in its journey as a nation, most of us are in a wealth accumulation stage.
Yes.
Right. So being able to articulate to the customer, that what are the requirements, why does he need wealth in the first place? So I think when you start your conversations around the requirements of the customer, what are their aspirations, and what you do as an advisor is really translate that into something which is financial, and then, build a roadmap to achieve that. So that's what you do on a very simple basis. So encouraging customers to talk about their finances, get more aware, and essentially spend more time about your own finances. I think that's the game to be played.
Especially the young investors, and of course now even the older ones, but especially the young investors are the very tech-savvy ones. How can technology be used to make it easier for them to easily come into the market?
New investors, no matter what, they are tech-savvy and they will like everything online, they will like everything to invest online. Advisors think that if we allow them to invest online, they will one day go direct. While some of the cases may happen like this, but most of the clients do not do that. Most of the clients are loyal. So rather than being apprehensive, he should give time to understand technology, put the systems in place in his own office, and tell the client to use technology. That way you can get a lot of NRI clients. The problem is that the mindset is that technology is a destroyer rather than enabler.
You're watching the Bhubaneswar edition of the Financial Advisor Forums 2014-15 presented by UTI Mutual Fund and CNBC TV 18. It's time for a short break. Don't go anywhere. We'll be right back. Well, Welcome back. You're watching the Financial Advisor Forums 2014-15 presented by UTI Mutual Fund and CNBC TV18. Joining me on the panel are Suraj Keli, Naresh Pachisia and Brijesh Dalmia. The mutual fund industry has to be attractive for people to want to become IFAs. Your advice how that should be done? How can that be done?
Let's start with defining the size of the opportunity.
Yeah.
Right? India is a country of savers. And households on an average save about 23%, on a gross GDP basis.
Correct.
Over time, look at the trends which are there. We are getting wealthier, which means that when you retire, you will retire with a much better lifestyle than where you started off. So actually, the size of savings which is required for you to just lead the same lifestyle that you have current, and because it's improving, is so large, and I think that's really the opportunity that you have. So you must get convinced about that there's a huge opportunity, and I think it's very obvious. Once you start talking to anyone around you, you can sense that opportunity, and we call it the demographic dividend that I think India is looking forward to. Yes. And the most biggest factor is a lot of satisfaction for yourself that you have helped households, manage their money much better, and because of you, they are leading lives which are really very worthwhile, So at least financially, you've made that security for them. So I think it's a very noble profession to be in.
Mr. Pachisia, I want to talk to you about something which is a little away from the mutual fund industry. I want to talk to you about chit funds. There is a point of time when they were the rage. Everyone was talking about chit funds, and people, especially in this eastern belt of the country, West Bengal, Orissa, where people were investing easily into chit funds. Your advice to financial advisors now, that how should they maybe make it easier for people to invest in mutual funds now?
The commission drove the advisors towards selling chit funds because they are getting high commission, and because some of these advisors would be close to the potential investors, so the investors trusted also, and it was convenient. So everything went off pretty well. But one big thing that has been missed out in this is that these were unregulated products, whereas mutual funds are very, very smartly regulated products. Yes. You are actually doing a good job, honorable job, respectable job. And so I think that respectfulness that you get, respectability that you get, I think that itself is a big draw for selling regulated products like mutual funds.
Brijesh, I would like you to comment on how often is it too often to monitor one's portfolio?
The more number of time you do the rebalancing, the more cost is involved, the more taxations are involved. So a passive portfolio approach should be there. And there should be a predefined mechanism that we will review the portfolio for rebalancing in 3 years or 5 years. And if the asset allocation in equity or debt is moving beyond 10% of the expected lines, then only we will do the rebalancing.
Suraj, last question to you. What has the budget brought for the mutual fund industry?
After several years, I feel that when you look at the budget numbers, you feel that all the numbers there are very credible. Okay. This is one common feedback that you get for everyone. So as a result, what we are experiencing is that, we believe that the budget is very positive for the equity markets. And if equity markets are doing well, you will attract more customers, irrespective of all the other factors which are involved. On the fixed income side, I think all of us were expecting that eventually the budget should give a clear roadmap on fiscal consolidation. I think that has happened. I think the trend of interest rates to go down will continue. I do believe it was fantastic for the overall market, and I think that would rub on positively for the mutual funds. So I think we're very excited about the budget.
Okay, great. So it's been a very interesting panel. We've come up with some great thoughts here. It's important to be in this for the long term to grow the trust of your clients. And yes, definitely the economy of the country is looking positive. So it should hopefully be a good way ahead. Thank you so much, gentlemen, for being here. But before we just wind up this, we have a couple of questions from the audience. Sita Kanta Panigrahi, he's asked that, what can the AMC industry should do to expand investor base, especially in the B15 areas?
I think a lot of work has to be done in creating awareness fundamentally. That, I think, is the first starting point. I think there are a lot of new channels of distribution that also can evolve over a period of time. So I think that will also help in, spreading in B15 towns. But most importantly, I think technology, which we have been talking about today, I do believe leveraging the mobile, right, which because all of us really carry an instrument. And if we can enable transactions on it, make it very simple for investors to participate, communicate with them in a very simple language, because we tend to use a lot of jargon at times, and that really puts people off. I think the ease of doing a mutual fund transaction will be the key driver in the 15 towns.
Mohammad Irfan, he had asked what and how the MF utility platform is going to add value to investors and distributors.
Today, if you have to have 3 people in your office to service your 200 odd clients, tomorrow you can do away with one person. Or those people who do not have any employee in their office can do it themselves with the MF utility platform. It will reduce your time fundamentally in paperwork and other activities, which you can essentially use in selling and be in front of the client. This is again a change which is coming in the industry. I am very positive about this. We should all be very positive about this. This will help you transform your business in the days and months to come.
This is a question asked by Sushil Das. He says that FMP returns are declining vis-a-vis bank deposit rates. How should you pitch this product to the investors?
If you have clients who have at least a 3-year time horizon with them, try and move them from fixed maturity plans towards debt funds because we are fairly confident that as the growth rate in the, as Indian economy grows higher and interest rates come down, debt funds are certainly likely to give you more returns than bank fixed deposits or fixed maturity plans of various mutual funds. So, and plus, post 3 years, if you were to take out that money, redeem, you are likely to have the returns as tax-free also.
That's a very nice thought to end the discussion on. Thank you so much, gentlemen, for being here. Well, that's all that we have on this Bhubaneswar edition of the Financial Advisor Forums 2014-15, presented by UTI Mutual Fund and CNBC TV18. But we'll come back shortly from Pune, which is regarded as one of the fastest growing cities in the Asia-Pacific region. Until next time, from the entire team, many thanks for watching.